Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 15th, 2020. We'll take a very quick look at the broad markets. We have some interesting developments to note today. I did fire off a post this morning showing those levels, and I wanted to do an update on a couple of the other commodities I've been watching, natural gas and coffee. So we'll start here with the equity market. Okay, so the biggest thing today is I'm going to turn on the pre-market session trades. You can see a little bit better. There we go. We hit that, what I referred to on Monday when we hit these uppermost bounce targets late. I said I think it was Monday morning before the market opened, minimum pullback target 286, and that's right here. Why? Because that 285.79 is the gap right there, and so minimum I was expecting a gap backfill. Plus it comes in with the trend line as well, so you can see when you zoom in real tight, that was this morning's pre-market candle right there at about 6 a.m. We were pretty much there. Futures have taken us down to that point, and that's what you get. Sometimes the Qs will hit levels in pre-market session, support and resistance levels, and then reverse. And you can look at the 1 minute chart. Need to turn on those pre-market data. Here we go. And this is what it looks like on a 1 minute chart. So you can see you hit it here, and so far good for about a 1.25% bounce off that level. That's a reaction. As I said this morning in the post, at minimum, expect at least a reaction. A reaction I define as a bounce and or consolidation on the initial tag. So it's a big support level. I mean, traders love gaps. Everybody's watching a gap. Once a gap gets entered, like it did this morning, it typically is backfilled. Not always, but usually. And that's what happened there. So that's active trading stuff. I told you I'm really turning my focus at least on the equity markets to more short term with the elections coming up. Intermediate term, longer term, let's wait and see what happens before and after November 7th. But as of now, support is hit. It's good for an active trader to cover any shorts or to bounce, reverse to a long. Now, okay, where do we go from here? That's the big question. All right, let's see if I can draw an uptrend line right here. It's not super well defined, but I have a few reactions coming off these top candles. So let's look at that. Pop above that would also coincide with a pop above that 293.14 resistance right there. Roughly, I could tweak that line ever so slightly. We'll call it 293.40. Either way, I think that will open the door up for a move to new highs and beyond. So like I said this morning, that would be the bullish case. We're not far from new highs, but remember, we're not there yet. We're still below where we peaked back here in early September. So still anybody's game, and near term, I think that's what's going to determine this. So there we are. Let me turn off all the pre-market trades real quick. Okay. That just makes it a little more clear. So now what are we looking at? So this was the gap right here. Again, the pre-market trades are off, so you don't see the gap backfill. But now we have another gap also right here, today's gap. And that yellow line marks yesterday's close, so that's the top of today's gap. And that would be a natural resistance level on any bounce today. So if that's taken out, then the downtrend line, each of those in themselves would be bullish technical events, break above that, in other words, if we go positive today, or that downtrend line gets taken out, those are positive events that are going to increase the odds that we're going to go up and take out that previous, of course, there's that previous reaction high and then the other highs. However, that is stated back then, and since my minimum downside target, there's still very much a possibility that we come in and back test the tops of these trading ranges. I'm referring to the recent multi-month trading ranges. This is the resistance, more of a resistance zone, about 280.32 up to about 282.71. And you can see that we've cracked this trend line. So what we're going to do is we're going to look at the FAAMGs as well real quick to see if we can glean any clues. I'm going to drag this trend line. This is the one that I've had on the chart for the last few days. I'm going to put it right here and to give a benefit of the doubt trend line, because there's one little candle right here, and that's also coming in with the bottom of the gap. So here it is. So if we reverse today, tomorrow, and we take out today's pre-market lows, let's just call it the bottom of the gap around 285.79. I believe that will open the door for, well, at the very least, a test at the top of the range. I think we'd come all the way back to that 280.32 level, and who knows, maybe more. And of course, the small caps, same story. Just like QQQ, we had that small wedge, negative divergence, extreme overbought conditions recently. There it was right there. One of the most extreme overbought readings on the 60-minute chart in quite a while. We became a little less overbought while putting in that negative divergence. That's what it's all about. So quite often when you have an extreme reading, it's not that initial extreme reading, it's the subsequent lower reading that gives you the negative divergence, like right here, and then the correction sets in. And that's what happened there. We had a breakdown, went sideways for just a little bit because the large caps were holding up, and then IWM went on to hit that trend line, which was my target, as well as the I think pretty important 159-ish resistance, now support zone. What is that? That's the breakout. Remember, we had a previous major reaction high right here. Sell signal was triggered back then at the time, and that led to the again biggest drop that we've had in many months in IWM. Before all is said and done, IWM from that point, and again a sell signal on the site was issued, then it fell about 11%. And so what we did is we recently took out that previous reaction high, and now we're back testing it. So if we go much lower, you have dual support. You have price support right there, again the 159-ish level, and you have the uptrend line, dual support. This is where the bulls should step in and buy, and if they do, great, that's bullish. That's just basically a back test of the breakout. Anything much more than that is a failure of the breakout, aka bull trap, meaning false breakout, failed breakout, etc. If we fall much below that 159-ish level. At the very least, expect a reaction. That's what we've had so far. You can see, since this morning's lows, there's been a little bit of a bounce. You're going to get at least a reaction. I'd be, very surprised if we didn't, and again, so far it's been more of a reaction in time. It's just consolidating. The bounce has been pretty muted there in IWM. What does it need to help firm up the bullish case? Well, obviously, they need to defend this level, as I just said. There's also the top of the gap right there, and then the recent highs. So bull case, bear case. Let's keep it pretty simple. And of course, keep in mind, in the bear case, if we fall much below, QQQ has a little bit of room before any technical damage is done. Like I said, minimum target was hit. I'm just going to loop back there. But there's still pretty significant support where that breakout occurred right here. So QQQ could fall a little bit more and really not do much technical damage. It would just be a breakout and a back test. Although I'll have to say this, that breakout was pretty impulsive. We got pretty far away from there. Usually if you're going to back test, it's a minor 2-3%, then a pullback to back test. We got so far away. If they fade the entire post breakout rally, not a good thing. Not a good thing for the bulls. But again, let's take it one day at a time, 1 minute at a time here, or hour at a time, hourly candles, I should say. These are 60-minute charts. All right, FAAMGs, we'll run through those real quick because that makes a difference of where we're going to go. And again, if you're trading QQQ, I think you're doing an injustice if you don't have charts up or you don't keep checking the charts of the big FAAMGs because they're going to determine where QQQ goes. This is Apple. Apple, right here, pierced into the gap at the open today, but so far held it. So Apple right now is defending gaps, the top of the gap right there. Again, it only briefly moved in and jumped right back above it. So, from the more intermediate term point of view, this is a long-term downtrend line I mentioned just recently that we tested and were rejected off. And that's so far we've been moving down. You can't call it uber bearish or anything like that, but it so far, like I said, a rejection of the trend line, but the near-term trend since the lows has been bullish. So where does that start to come into question? Well, you could draw an uptrend line like that. Let me draw it like this. Here's an uptrend line right here. Maybe tighten it up just like this. And so pretty much right here, that's where I think, and it kind of ties in with everything I just said about RTY, or I'm sorry, IWM, the small caps, QQQ, all those hitting supports, hitting the near minimum pullback targets. And so I'll keep it very simple. I think should they hold these levels and rally? Great, that's bullish. It's where the buyers should have stepped in. Your markets got a little bit ahead of themselves after the breakout last Friday. Rallying quite a bit since then, getting very overbought. So the buyers, this is where, again, quote unquote, should step in. When I say should, doesn't mean it will. It's just where logically the buyers should step in to defend these levels. If they don't, then, and if we take out today's lows by much, what we're going to do is we're going to start cracking a lot of supports. We're going to crack trend lines. We're going to crack below the potential, the bottom of those gaps, those big gaps that we had the other day. That was Friday's gap into Monday morning. So that's it. Pretty much a break. Not a tenth of a percent, but a solid break below today's lows, and you can see it, of course. QQQ and IWM I already covered. Apple right here, you can see where the technical damage will occur. The gap will be backfilled and then some. Trend line will be taken out. Amazon, and of course on Apple, I've said it 100 times, we're still below. We not only were rejected off the trend line as well as the 61.8 fib the other day, we are also rejected off the bottom of the what I think is a big significant technical level. That's the range where all the Apple split buyers jumped in, bought the stock thinking that the split was, like the press was saying, uber bullish, and normally they are, but sometimes they can mark a buying climax. And so far, until unless that's taken out, that's what I'm viewing it as. So there it is. Enough talking about Apple. Keep it simple. It's that support. If I was an Apple bull expecting new highs, not concerned about the elections or anything coming up, I would be buying right here. I would be buying with a stop below. It's not the case for me, but again, I do this, everyone's different. Sometimes I'm wrong, and my job is to show you objective levels, to either buy or sell, go short, take profits, things like that, and then you decide which way you want to position. Very near-term uptrend line too. I know I'm still talking about Apple. I can't shut up on it. It's a big stock. It's biggest in the Nasdaq 100, largest in the S&P 500. So it should be talked about a lot. Little minor downtrend line is what I wanted to show you right there. Just marked up. Okay, moving on. We'll go through these quicker. Amazon, nice, almost a perfect gap backfill. You can see that 60-minute candle this morning. The first candle is a 30-minute candle, really. We have 6.5 hours in the trading day, so the first candle is a 30-minute candle. It's between 9:30 a.m. to 10 a.m., and then every one thereafter is one hour. So, but a perfect, look at that, right on the bottom, right on the gap. That's what this box is, these orange lines right here. And you can see perfect gap backfill. So, but on the flip side, we also took out an uptrend line. So there's kind of a mixed bag on the very near term, at least on this one and some of the others, with trend lines being taken out, gap support held. But the story remains the same as what I was talking about on Apple and QQQ. Pretty much anything much more than a break at today's lows is going to be bearish, because we've already backfilled that gap. This is where, again, quote unquote, the bulls should be stepping in to buy on the gap backfill. And if they don't, well, it opens the door to the next support. And if that breaks, then it opens the door to the next support level. Microsoft, Mr. Softy, same thing. The gap was so small on Microsoft, it wasn't as big as the others. And again, right there it is, right there. I'm boxing in. This is the gap from Monday. I'm sorry. Perfect gap backfill. So there's the common theme here, and this is, if you're new to trading, the takeaway is watch gaps. Traders watch gaps. They trade around gaps. They are logical support levels, especially if it coincides, which this one does, with a much bigger, more significant support level, and that is this orange box right here that I have, and I've had on this chart. I've covered it many times in the past few weeks. That is a multi-month trading range. Microsoft has bounced between that range all the way back here from June in this range, top bottom, watch, rinse, repeat. One little false breakout period, it broke out, put in a divergent high. As I often say, breakouts that occur with negative divergences and overbought conditions have a much higher rate of failing. That's most certainly what happened there. That led to the biggest correction of Microsoft in months. Once the breakout failed, we went right back down, entered the trading range, and right back down to the bottom. So again, finally we broke out again, and here it is. We're back testing. So I'm repeating the same thing over and over, but it's what I see in the charts and what I believe to be true. This is where the bulls, quote unquote, should step in. You break out in a back test. Some back tests are successful. This one wasn't. We came back in, fell in the range. If the bulls can step in here and buy, that's going to be bullish. If they fail, we're going to enter the range again. Well, what's been the history? Every time we get to the top of the range or we fall back down in it, the history has been you move back down to the bottom of the range. So this time you hit the midpoint. And that's another thing I always mention. Anytime I've come across a trading range, whether it's a sideways trading range or even a price channel, let's say, a horizontal or a ascending price channel or descending for that matter, I can almost put just about every time take a line right about in the center, and it's amazing how often that center point will often act as support and resistance, and you can trade off that as well. Big old gap right there, reaction, you buy it. So I talk about the top and bottom of trading ranges, but I always like to add that center point line because that would be in other words, if we enter it, that would be my minimum target, pull back to the center point of the range. And if the center point gives way, then I'd probably take you back down to the bottom. But until then, like I often say, support is support until unless broken. So there it is, Microsoft pulling back to support, gap support, top of the range. Again, if you're bullish, this is where you go long with stops below. And if you're bearish, you want to wait and see if we can break today's lows, and that would be our sell signal. Google, this is Class A shares, the GOGL, the L at the end. There's your gap right there. Actually, Google broke the trend line, minor trend line. It's not a very big one, but it's worth noting, enough reactions. And so far above, so this is the first support level, or the next support level. First support was the trend line. We broke that today. We're below it. Should we have another leg down, look for the top of the gap to come in as a potential support. If the top of the gap is taken out, then the bottom of the gap would be your next logical support level. Facebook, as I'm doing the video, almost a perfect gap backfill. Entered the gap this morning. You can see on the gap down what you're looking at here on this chart. Again, these are 60-minute charts. That yellow line, that's where we closed yesterday. We gapped down today into the gap, and unlike was it Apple that was managed to push back up, Facebook could not. So we printed a 60-minute or that first 30-minute candle close inside the gap, and then since it couldn't recover, snap back above, it made a gap backfill, and that's where we are right now. That's a red candle, so we're at the bottom of that level, and that's gap support. Same thing holds true. We break much lower than where we're at now, by a pretty good margin, especially 60-minute close. That means gap support's given way, and that would most likely bring in another wave of selling as longs that stepped in today. One of many reasons, but let's say I was bullish and long, stepping in, covering shorts, reversing, going long, or buying the gap here, whatever. My logical stops would be a little bit below the bottom of the gap. Just below support. That's TA 101. If you want to go long, you either go long on a breakout above resistance, like this little triangle pattern here. There's an objective long if we broke above there, which we didn't, but that would be. And the other way to go objectively enter a long position is on a pullback to support. So if that support holds, great, you're rewarded. If it doesn't, don't become married to the trade. Now, depending on where you think Facebook is going, you could use it. You don't have to use a very tight stop. If you're expecting new highs and beyond, there's a nice uptrend line here. So if the gap goes, that would be your next logical support level right here. This uptrend line comes off the September 21st lows. And Tesla, I've been looping in with the FAAMGs lately, and then we'll move on. In that same story, here's our post-stock split range. Everybody that got excited and bought Tesla on the split bought between here and here, and then suffered a huge drop, and Tesla plunged after that, dropped about 35%. So anybody that rode out a 35% pullback, more power to you. I imagine some did, and so the stock has had a pattern of every time it gets up towards the bottom of that split range, the sellers have stepped in. So far this time around, here's that first test. We failed right about where we did back here on the first time we entered that range at about mid-September right there. That's why I dragged that line across. And we're still in there. And the big levels to watch are these trend lines. I have dual intersecting trend lines below. And so that's what I'm watching for on Tesla. You know, bullish if the stock can take back and then get above that split range. It's going to take out the previous highs. Then it'll be at a new all-time high, and then everybody that rode out that 35% drop will be rewarded for sticking with it. Otherwise, if it starts to do this again, you'll probably, especially if we start taking out these prior lows, you're going to see some probably a lot of people throwing in the towel in giving up, because it's now been since that split where we're 1.5 months after the split occurred. All right, that's enough on the broad markets. We'll see where we go. You have the levels to watch. Again, we are at support, hit it this morning in pre-market and around the open. So we should rally. So far we've had a reaction that we are up since the pre-market lows. And my thoughts as to where we go from here if we break much below today's lows. Coffee, just a quick update there. I'm not crazy about today's price action. It doesn't completely wipe out the bullish posture, but I would have preferred to see a little more giddy up. Coffee usually, once it starts a bull trend, it tends to really run in those trends and have a pretty strong advance. So as pointed out recently, we had a breakout. This is JO, the coffee ETN. We had a bullish falling wedge, an impulsive breakout, rallied right up to the first target there, 33.92, got checked. But we're back down now towards, close to those recent lows. This is support, 32.30. Again, from the whole technical posture, it's still constructive, and it could certainly go. It's just not ideal. Usually, again, I like to see coffee have these what I call unidirectional rips and dips. That's usually the trends. Coffee sometimes can move sideways. Sometimes it doesn't take off for a while. Here's a good example. And we were along, it's an official trade on this one. We had a downtrend line, same thing, positive divergence. That gives you a little wedge type, push wedge pattern. And it broke out, and it kind of didn't get going right away. It came back in below the breakout point, but it stayed below the previous lows, floundered around for a while, and then boom, corrective wave one, final. That's an ABC up, and that whole move, from the breakout point was about 34% in a matter of just a couple months. So it can take off. I would just have preferred to have seen it by now break that 33.92 level. And we look at KC coffee futures for those of you trading the futures. I've got it here somewhere. There it is. Let me make sure this is up to date here. You had a minor trend line right here. That's been taken out. I'm not crazy about that. So let me just be clear. You're still coming off a divergent low. That divergent low is still intact. We're not there yet. And I mentioned a stop could be placed below that low. I wouldn't add to this now if I didn't already have it. And so I would wait to see. At this point, you want to see coffee hold below that previous low, ideally. Now look, here's the thing. It can take out that previous low, and if it does so soon, it's going to do so with positive divergence still. You just have to decide if you took it here, or anytime recently, how much room you want to give it. But I will say that the divergences are still very much intact, and if we take out that previous low anytime soon, it's going to be guaranteed to be a divergent low, even bigger positive divergence than we had here at this recent low. But the fact it fell back below 108.60, below the trend line, again, not ideal bullish action, but it hasn't negated the this bullish technical posture yet. So I wanted to give you that update and say maybe just wait and see if coffee can turn around soon, and what you want to see on coffee futures. You want to see this previous high taken out, and that would still remain the first target there, about 114.94. We'll call that 115. Last but not least, natural gas, one of the other few commodities I'm really focused on right now at this time. For active trading stuff, downtrend line and that 219, that was a price target and was second target, I guess. Yeah, because we had this bullish falling wedge right here, positive divergence. That was a catalyst. Breakout, hit the 2708 resistance target, back tested the wedge, moved up, then took out the 2708 and hit this level, at which time it did an update, said that's an objective time to book profits. You had not one but two resistance levels there, the 2915 price resistance, all these reaction highs, as well as a pretty well-defined downtrend line. And the fact that we, even as I was doing the video that day, we were continuing to consolidate there, gave you plenty of opportunities during the regular trading session, not 3 in the morning, to get out and take profits and then either recycle back in. And that also gave us an additional validation of this trend line. Remember, that started out, it was really only a potential trend line because I had a few reactions from here. The fact that we had those reactions that we consolidated and then pulled back, and then another reaction right there since. So this is a big level now, and so far, if you look at it this way, since that divergent low, we're in an uptrend. We're in a near-term uptrend. This remains now even a more significant resistance level, and that will trigger the next buy signal. This is our low right here, our divergent low, and you can see as I'm doing here, we've been stair-stepping higher. This is an uptrend. Natural gas is a little volatile, so you're going to see pretty big swings in the trend, but as of now, there's our uptrend, and you want to see it remain above this 2592 level ideally. We already back tested it and moved up, so boom, need to pop the trend line. Pop the trend line, you're going to still have that 2915 level to contend with, but we've already hit it a few times. So we could, I think it's possible if we take out the trend line, we could pop on through there. If you want to be safe, you wait till 2915 goes, but that would open the door to the next target here, 3146 or so right there. And for those of you that trade ETNs instead of futures, UNGs, probably your best bet with natural gas. Same story. Divergent low, positive divergence, moving up, walking its way up since then. Came back in below the downtrend line, but it held that 1175 support right there so far. And again, you need to see the next buy signal comes on a break above about that 13-ish level, and that should take us up to at least that $14 target, if so. So at this point, I can't even recommend a stop because there's so many areas that you could have entered, re-entered, as I mentioned the other day, objective to take a profit here. So let's just say hypothetically you entered re-entered on a pullback at 1175. Then, especially at this point, we've already bounced off that level. I think it makes sense to probably raise stops to break even now, either at 1175 or not too far below. And again, you may have entered here, 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 here. So wherever you entered and wherever you think natural gas is going, that should determine where your targets are. Where your targets and stops are. Those are go hand in hand. Higher your price target, the wider stop you can use. Small, tight, price targets, small, aggressive, tight stops. Okay, let's wrap it up here. I want to get this out to you. Gold and silver are still mostly dead money, sideways trades. I'll do an update whenever there's anything significant there. And right now, I'm really, watching these markets kind of near term, taking it tick by tick, minute by minute. And, I'll tell you, I'm leaning towards this scenario and come on down and back test the top of the ranges. Oh, that's one reason why I need to loop back to this. From time to time, I need to update, share my thoughts, especially for a few reasons. There's, members of the site that come in from time to time. Some people are more active, reading up on every post and videos that come out. Other people check in from time to time, and then you have new people come into the site. Every bit, I'm still every bit factoring in what happened recently in the put to call ratios. These are some of the most accurate sentiment indicators as far as predicting where the market might go. What I mean by that is one of the popular ones out there is the AAII. That's the American Association of Individual Investors, and it polls people, verbally whether they're bullish or bearish. Whereas the put to call ratios, as I like to say, that's people putting their money where their mouth is. By buying a lot of calls, when the amount of calls to put buying is excessive, it means everybody's bullish. Vice versa, when there's a lot more put buying than call buying, means the majority of people are bearish. So as you can see, and I've covered it many times, but I'll just hit on it again. Here's my line with extreme bearishness, fear, and this is when you want to be going long, especially after a big, and it usually does spike after a correction. Let me just change the color there. So there's a spike that marked a major bottom right there. That was one of the best long entries in years, as was this one right here. And so you can see this is when you want to be going long, when everybody's scared, everybody's bearish, and more importantly, not just talking about it, but loading up on puts. What it does, there are dynamics. The commercials have to then hedge those positions, and so when you have these extremes, this extreme put buying or extreme call buying, they tend to put floors or tops in the market, at least for the time being. You could see it was the end of the last great bear market in 2009. You can see excessive fear leading up to that, and you had the first time you had a big rally. That was a huge rally back in November, and then there was the other one, and that marked the end of the bear market. So without fail, I mean, you're going to use one single sentiment indicator. This is my favorite right here. The CPCE also does a really good job, and again, I marked all the levels. So this is where you get that extreme bullishness. You can see the arrows. These are the biggest corrections that we've had throughout the bull market, and you can see what happened after we hit that red line. This is my extreme bullishness, complacency, meaning everybody's loading up on calls because they think the market's going higher. They don't want to buy a lot of puts. That's what this measures, put to call ratio. And you can see what's happened in the past. And this is not just a one and done or a single tap. This is a cluster. This shows persistent excessive bullishness with multiple readings on or at that line right there, yet nothing so far. So I want to just continue to add that this plays into my longer term outlook. There's not a single indicator that is 100% effective. So unfortunately, it's had a great track record with 0 false signals. Will this be different this time? Anything's possible. But again, this just shows me we're still there where there's very, very little fear in the market. And, it's going to take the right technical catalyst for this to play out. And if it does, again, the history is pretty big corrections, measuring well into the double digits. And we did have the biggest correction since the March lows, and it was double digit, but again, it doesn't line up with the magnitude of these previous corrections when we had such readings there on the put to call ratio. This is the equity put to call ratio. Okay, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.